A very special guest now joins us. Rajeev Thakkar is with us. He also does a lot of global investment. So Rajeev, earlier as you had done a lot of global investments, there were global trades which were better than Indian trades. But with India outperforming, what is the sense that you get? You think a lot of global flows are now coming into India on a structural basis, leading to this outperformance? That you know we've had some technical issue with the okay. Just focus. Let's do the market check as well. So 20 points higher for the Nifty, small cap index 0.5%, mid cap index 0.3%. If I look at the Nifty 100 and some of the gainers and losers as far as the space is concerned, so Tata Motors continues to gain. It's up 3.5%. If I'm not wrong, it will be up more than about 11% in the last couple of days. Avenue Supermarts is up 3%. Vedanta is up about 2.5%. Bandhan Bank, which fell down quite substantially yesterday, 1% higher. Hindalco, some aluminium upgrades have come in. We'll focus on that. Vedanta is also up 2.5%, so we'll tell you about that JP Morgan upgrade. Piramal is up 1.8%. Wipro is up 1%. SBI, Havells, Bajaj Auto, HPCL, Yes Bank, Aurobindo Pharma are some of the other gainers. In terms of losers, Indus Tower is down 2.5%. No particular reason I can identify for the same, but that's a stock which has of late been a bullish stock, but right now you just get a sense that it's trying to make trying to retrace some of its earlier gains. 332 was the 52-week high. It's now at 295. M&M, again, the auto rally has been quite substantial. Infosys is down about 1% or so. Infosys declares numbers tomorrow post-market hours. Meanwhile, as we go to Rajeev Thakkar, let's hear out what Sunil Singhania, big market veteran here in India, told us earlier when we spoke to him about Nifty levels and what to watch out ahead.
We have seen this many times before, markets have their own sort of a behavior. And the fact of the matter is that we have come out of a period where things were looking down and out completely. And from there, in fact, things have turned out much, much better than what all of us expected. In fact, as we speak, there is so much optimism, not only in the few sectors which we used to see maybe 3, 4, 5 years back, but across the spectrum of the country. On top of it, obviously, the liquidity has also helped. So I think we are in a period, and we are heading into a period where growth looks like surprising. We have near-term headwinds coming in terms of rising input cost. But I think the demand scenario is so good that you're able to pass on a lot of these increases. On top of it, obviously, you have a little bit of retail, I would say, interest which has reignited, and that also is leading to pockets of maybe overvaluation as far as the markets are concerned. So we are heading in for a good and interesting time. I think this milestones of 50,000, 60,000 are obviously big milestones. But just because the market is at a particular milestone, we should get bearish or bullish. At least I don't subscribe to that notion.
Sunil, what are the chances that we could be in for a bull market like never before? And I'm just going to throw some perspective here for our viewers, that normally we've seen a bull and a bear market cycle, they last for 3 to 4 years. But Sunil, what are the chances that we could be in like a bull market, what we have seen in United States, a 10-12-year-old bull market and still alive and kicking?
So, Nikunj, I think we always try to, mistake ourselves and get swayed by data points, So, market at 60,000 is a warning signal, for example, or P of X is a warning signal, and so on and so forth. And I think you rightly said before you came to me that people are trying to find mandi in this market. And I think the biggest strength of this market has been the frequent but small corrections. Every month we have this 4-5% correction. Every month we have some of the other things which sort of make us cautious, whether it is taper tantrum, the China issues, Evergrande, and so on and so forth. And I think that is what is making the market very healthy. We are still in a scenario where most investors are looking for a correction to enter the market rather than looking at an upside to exit the market. And I think that makes this market very healthy. On top of it, there are a lot of tailwinds. Tailwinds, as I said, from fundamentals. Tailwinds also from a never before initiatives from the government. Privatization, we have already hopefully seen, the airline being privatized more on the anvil. We are finally seeing private capex coming back, largely led by, demand coming in across the sectors. And for a change, our exports are also looking to be quite healthy. Yes, there are, near-term, I would say, speed breakers in the sense you have a logistics issue, you have, energy costs which are going up across the world, you have raw material costs which are rising. There's a lot of volatility. It's easy to be an investor today, but it's very difficult to be an entrepreneur or a manufacturer because of the varied variables they have to manage. But I think all said and done, we are in a decent sort of move. Now, whether this lasts for 3 years, 5 years, 10 years, we don't know. Whether there will be correction. There will definitely be correction. But I would say that India has been in a decent phase for the last 20 years. Despite all the ups and downs which we have seen, I think the last 20 years returns have been phenomenal. So, I think we're already in a good sort of a scenario, and there is no reason for us to believe that the next 5-10 years are also going to be quite interesting and beneficial for investors.
That was none other than Sunil Singhania on the markets, talking about how corrections can be buying opportunities in this sort of a bull market. Let's also hear out from another market veteran, Madhu Kela. We spoke to him earlier, who says that yes, markets have gone up, but there is no reason why they cannot go up further from here on.
Obviously, the markets have gone up a lot in the last 18 months. There's been a significant rise in the mid-cap index, small cap index, and the indices itself. This obviously, needless to mention, is also in the backdrop of what has happened in the global markets. So our rise has not been in an isolation, essentially. And also, the quantum of money, Nikunj, being made in the last 18 months in the global markets is $60 trillion, while in India it is $1.7, $1.8 trillion. So this we've been part of a big global market boom, which is driven by liquidity and low interest rates. So my point is that, will there be corrections? There will always be corrections, and the corrections, as you and I know, for last 30 years of being here, where they will always come for reasons which are not known to us today, and they will come when people are expecting it the least, right? And so, but do I really see any kind of a crash, or do I see any abrupt thing which will take the market down significantly? Nikunj, I don't see any of that. In my view, any correction which comes will still be a buying opportunity in the markets.
Okay. So Madhu, what you're telling our viewers is that there is a difference in crash and correction. We are not headed for a crash, but a bout of volatility, an ugly patch of correction cannot be ruled out.
Yes. And Nikunj, over the years, what I have also learned to differentiate between what is a risk and what is volatility. Like, the volatility can be there in any markets, in any stocks, any company. But risk is when you are stand to lose out your capital, or you lose out 80-90% of your, of your company. That we have seen, you and I have seen over the years, and we have made all very risky investments.
Right, you can catch that entire conversation that we've had with Madhu Kela on our social media platforms. I'm now going to go across to Rajeev Thakkar of PPFAS. Hope we have you on a better connection this time, Rajeev. It's perils of live television, isn't it? Good morning. It's Nentara. I think since the last 2 days, one of the conversations people are having on the street is, A, of course, the energy crisis, but second one, IT ka time khatam ho gaya kya? Like, if you just see the kind of outperformance that we saw from the IT sector to the start of this month, phenomenal returns of 120 to 150% year to date in some of the instances. Now, disappointment that is creeping in. Tech stocks, have they peaked out? I think that's the first thing people want to know.
So it would depend on company to company. I think the mid cap space has run up very, very significantly. And as you rightly pointed out, the overall IT pack has also gone up quite a bit. And valuations in a lot of companies were getting out of hand. And the results coming in are more of a reality check. It's not that the sector is not growing or profits are not there. It's just that the expectations that were built up in the valuations had gotten a bit out of hand, and we are seeing some correction in that on that front. I wouldn't say that the story is over. So all the positive factors that are there in terms of the demand drivers in the post-COVID world, where people want to move to the digital space and improve the customer online experience, all those things are there. Demand drivers are there, and growth will be there. But one has to be mindful of the valuations which had gotten out of hand.
So then that'll fit in with the larger theme, right? Of maybe shifting from the mid-cap IT stocks to the large cap, a different kind of a rotation.
Yes, that would be correct. So some of the mid cap names have gone up almost 10x from the COVID lows. So obviously one has to be mindful of the valuations there, and no company can grow profits at that kind of a pace. So a lot of these are now quoting at 50 times earnings and 55 times earnings. So obviously there could be some disappointment for people who are buying at these levels. But the underlying quality of cash flows, quality of management, demand drivers, all those remain in place.
Okay, now, a lot of experts are talking about skewing their portfolio towards the deep value stocks. Fits in with the larger rotational play. There's a lot of brokerage reports that are also coming out that this is the time to play with the deep value cyclicals, as we call it. Do you agree with that? Or do you think that the deep value stocks, whether it's the power stocks, coal stocks, energy stocks, metal stocks, just because of what has been happening, have already run up?
So a lot of the deep value names that one is seeing are either in the PSU space or in the cyclical space. So PSUs have had a bad name in the market, and rightly so. So for many years there was capital misallocation happening. So in the last cycle, if we remember, where oil prices were going up and the marketing companies were not increasing prices and selling fuel at a loss, and plus regular drip of disinvestment would happen from the government in terms of secondary market offers and things like that. So this time round, clearly the approach is that one cannot continue doing that, and the focus has shifted more to privatization and strategic sales. So we have already seen the announcement as far as Air India goes. So the whole negative perception about PSUs, that is changing a bit. And the other thing is that a lot of these companies where the cash flows have been good, where the underlying business economics are reasonably intact, those were trading at very, very low valuations, whereas some of the hyped up sectors had really gotten to astronomical levels. So somewhat of a mean reversion is happening. You mentioned power stocks. So some of the power names are near monopolies in their area of operations. And we have also seen some of them monetize their assets by way of InvIT sales and things like that. So that is really improving the business characteristics for some of these so-called deep value names. And definitely people should be looking at that space rather than chasing some of the new IPOs where there is no underlying free cash flow and where there's only a promise of glory down the road.
Rajiv, how would you look at the manufacturing sector? There have been substantial changes as far as manufacturing is concerned. The way steel sector was looked, the way aluminium sector has been looked, or any other manufacturing sector. Do you think that's the space where one should focus on manufacturing, strong, efficient company? That's what investors should also focus on.
Definitely. So manufacturing obviously covers a broad spectrum. So you have the capital goods manufacturers, you have the metal manufacturers like steel that you mentioned, you have the automobile companies. So there's a big variety of manufacturing companies, and a lot of these are extremely well-run companies. The product quality is good, the capital efficiency is there, the growth vision is there. So one has to definitely look at this space and pick up companies selectively here.
Right. Aren't you worried about valuations getting out of the whack for most of the sectors? I mean, you've been in the markets for 30 years. TCS at 38 times, IT sector itself being at about 35 times, 34 times 1 year ahead. Doesn't it, look that the best is factored in, or because of interest rate changes, the sort of outlook that India has, all of that has particularly changed?
So clearly, the overall market valuations are at above average levels. The Indian IT pack, very surprisingly, is trading at a big premium to some of the global majors, which are very different kind of companies. So TCS trading at premium valuations as compared to, let's say, a Google or a Facebook or a Microsoft, that causes concern. The interest rate party will not continue forever. So obviously we are seeing signs of some amount of inflation buildup. The monetary policy normalizing is on the cards in terms of, at the first level, reduction in the pumping in of liquidity or some withdrawal of liquidity, and down the road some increase in short-term interest rates. So definitely it's a time to be cautious. It doesn't mean that sell everything and stay in cash. There are pockets of value. So one has to be discerning in terms of what one buys at this point in time. It's not definitely a market where one can indiscriminately pick stocks and expect to make a lot of returns. The other point is that the returns from here on, one should expect them to moderate significantly. One cannot take the past 12 to 18 months as a benchmark and project future returns anything near to that. In fact, one has to be extremely conservative when one looks at the future return possibilities from here on.
Additions that you made in the last month or two: Power Grid, ITC, and from the financials, ICICI Bank and Axis Bank. What's that about?
So going into the pandemic, we had reduced the weightage to the lenders very significantly. So the private sector banks, we thought, were the best placed in the financial space to ride out the storm. But still, despite that, there was uncertainty in terms of what would be the NPA levels coming out of COVID. And I think by now the things are clear that the COVID situation has not proved to be a fatal event for the lending companies. And a lot of shakeout has happened where weaker players have exited the lending space or have had very significant reduction in market share. So the private sector banks are well positioned to benefit from the CASA deposits that they have, the overall environment where lending rates could creep up a bit, where you could see a scenario where the market share shifts from the PSU and some of the weaker banks to the well-run private sector banks. So that has been a space where we have been adding investments. Some of the other names that you mentioned, things like ITC or things like Bajaj Holdings or things like Power Grid, these are companies where valuations are reasonable, where the frenzy of the last 12 to 18 months hasn't really been there, where obviously these are not very, very high growth companies where one could see 20-30% kind of earnings growth kind of thing, but these are stable free cash flow companies where the combination of dividend yield plus earnings growth will deliver a decent amount of total return. And again, in something like a power grid, again, one has seen them monetizing some of their past assets via the InvIT route. So that really improves the business prospects for the shareholders of the company.
Thank you so much for taking the time. That's certainly been an insightful conversation. A pleasure speaking with you as always.